The Debt Secret: How the Rich Use Debt to Buy the World. Rich versus broke. Society has lied to you about money. From the time you were young, you were told a very simple, very safe rule. Debt is bad. Pay off your credit cards, pay off your mortgage, and save your cash. It sounds responsible, doesn't it? But here's the uncomfortable truth. While the middle class is clipping coupons and trying to reach zero debt, the ultra-wealthy are borrowing millions, sometimes billions, of dollars. And they are doing it on purpose. Robert Kiyosaki, the author of the legendary book Rich Dad, Poor Dad, famously said, "There is good debt and bad debt. Good debt makes you rich, and bad debt makes you poor." Today, we are going to tear down the traditional advice. Over the next 30 minutes, we will deeply explore the exact psychology of money, how the broke and the rich view debt completely differently, and reveal the 7 specific debt strategies the top 1% use to grow richer. If you want to stop working for money and start making money work for you, grab a notepad. Let's begin. To understand debt, you must first understand human psychology. In his brilliant book, The Psychology of Money, Morgan Housel explains that doing well with money has a little to do with how smart you are and a lot to do with how you behave. The broke mindset views debt as a way to consume today what they haven't earned yet. It is the ultimate tool for instant gratification. When someone with a broke mindset gets a credit card with a $10,000 limit, they don't see a high-interest liability. They see a new wardrobe, a vacation, or a car upgrade. They are borrowing money from their future self with interest to buy something that will decrease in value. Feature: bad debt, the broke mindset. Good debt, the rich mindset. Purpose: buying liabilities, TVs, cars, vacations. Buying assets, real estate, businesses. Cash flow: takes money out of your pocket, puts money into your pocket. Value over time: depreciates, loses value. Appreciates, gains value. Who pays? You pay the interest, your tenants, customers pay it. The rich mindset views debt entirely differently. They do not view debt as a way to consume, they view it as a tool to produce. They view debt as leverage. Think of leverage like a tractor. A farmer could dig a 1-acre field with a shovel using his own energy. It would take weeks, or he could borrow money to buy a tractor, finish the field in 2 hours, and use the remaining time to plant 10 more acres. The debt bought the tractor, but the tractor multiplied the farmer's output. Ray Dalio, the billionaire investor, explains in his animated series How the Economic Machine Works that credit isn't inherently evil. Credit simply allows a borrower to consume more than they produce in the short term, in exchange for producing more than they consume in the long term. The rich use credit to build systems of production. You might be wondering, why not just save up the cash and buy the asset outright? Why risk borrowing? The answer comes down to 2 forces: time and inflation. Let's talk about inflation. Inflation is the invisible tax that eats away at the purchasing power of your cash. If inflation is at 5%, your cash in the bank is losing 5% of its value every year. But what happens to debt during inflation? Debt actually benefits from inflation if the interest rate is low enough. If you lock in a fixed-rate loan to buy an asset and the government prints more money causing inflation, the value of your asset goes up. But the amount of debt you owe stays exactly the same. You are paying back the bank with future dollars that are worth less than the dollars you borrowed. The wealthy understand this mathematical secret. Inflation destroys savers, but it enriches debtors who hold hard assets. The second reason is the math of leverage. In finance, there is a simple formula for return on investment, or ROI. ROI, investment, net profit x 100. Imagine a $100,000 property that appreciates by 10% in 1 year. If you buy it with $100,000 in cash, you made $10,000. Your return on investment is 10%. That is a solid return. But what if you used the rich mindset? You put down 20%, which is $20,000, and you borrow $80,000 from the bank. The property still goes up by 10%, meaning you still make a $10,000 profit. But you only invested $20,000 of your own money. Your ROI is now 50%. You just 5x'd your wealth building speed using the exact same asset. Now that we understand the philosophy and the math, let's look at the exact playbook. Here are the 7 debt strategies the rich use to grow richer. Strategy number 1, using other people's money. You don't need money to make money, you need a great deal. The wealthy routinely find highly profitable business or real estate deals, and instead of draining their own bank accounts, they pitch the deal to banks or private investors. The bank provides the capital. The asset generates cash flow. The bank gets paid their interest, and the wealthy investor keeps the spread. They essentially create wealth out of thin air by acting as the conductor of the deal. Strategy number 2, the buy, borrow, die strategy. This is how billionaires like Elon Musk or Jeff Bezos live lavishly without paying massive income taxes. When their stock goes up in value, they don't sell it. Selling triggers a massive capital gains tax. Instead, they go to a bank and use their stock as collateral for a massive, low-interest loan. The loan money is tax-free because debt is not income. They live off the borrowed money. Their assets continue to grow faster than the loan's interest rate, and upon death, their estate settles the debt, often bypassing massive tax hits. Strategy number 3, buy, rehab, rent, refinance, repeat. Popularized by real estate investors, this strategy involves buying a distressed property, fixing it up to force its value higher, and renting it out. Then, they go to the bank and do a cash-out refinance. The bank appraises the newly remodeled home and gives the investor a loan based on the new, higher value. The investor pulls all their original cash back out, tax-free, and uses it to buy the next property. The tenant's rent pays the new mortgage. Strategy number 4, business expansion debt. If a business owner knows that every $1 they put into marketing or new equipment yields $3 in profit, waiting to save cash is losing money. The wealthy use commercial loans to rapidly scale profitable systems. They borrow at 7% to fund operations that yield 20%. They capture the 13% difference on a massive scale. Strategy number 5, defensive refinancing. In times of economic uncertainty, cash is king. When interest rates drop, the wealthy refinance their existing debts, extending the terms to lower their monthly payments. This frees up monthly cash flow, creating a massive safety net and war chest to buy distressed assets when the market crashes. Strategy number 6, asset-backed margin loans. Similar to the billionaire strategy, high net worth individuals use margin accounts at brokerages. If they have $1 million in safe index funds, they can borrow a percentage of that instantly at very low rates to fund short-term opportunities, without ever interrupting the compound interest of their primary portfolio. Strategy number 7, seller financing. Sometimes the rich don't even use a bank. They negotiate directly with the seller of a business or property to act as the bank. They agree to pay the seller over time with the cash flow generated by the asset itself. This allows for flexible terms, lower down payments, and bypasses traditional bank limitations. We have spent this video talking about the immense power of leverage. But any tool that is powerful enough to build a skyscraper is also powerful enough to tear it down. Warren Buffett famously warned about the dangers of excessive leverage. He said, "I've seen more people fail because of liquor and leverage being borrowed money. You really don't need leverage in this world much. If you're smart, you're going to make a lot of money without borrowing." Buffett's warning is crucial. The strategies we discussed today are not for the financially uneducated. When you use leverage, you magnify your gains, but you also magnify your losses. If you borrow heavily to buy an asset, and that asset drops in value or stops producing income, the bank still expects their payment. This is called being over-leveraged, and it is how millions of people lost everything in 2008. The difference between the rich and the broke isn't just that the rich use debt. It's that the rich possess the financial education required to manage the risk of debt. They hold cash reserves. They stress test their properties to ensure they cash flow even if rents drop. They do not gamble, they calculate. If you want to transition from the broke mindset to the rich mindset, your first step isn't to run out and take on a loan. Your first step is to invest in your financial education. Read the books, study the markets, and learn to distinguish an asset from a liability. Stop seeing money as something to spend. Start seeing it as a tool to build. And once you master the rules of the game, you can use the world's capital to build your own empire. If you want to move beyond the hype and understand the actual mechanics of wealth, subscribe to the Wealth Laboratory. Every week, one new experiment. See you in the next one.